Changes to the off-payroll working rules have been a discussion within the contracting world for numerous years. Coronavirus had delayed the changes to the off-payroll working rules and will come into effect from the 6th of April 2021. Changes will apply where one of the following services are supplied: via an intermediary, such as a personal service company, to a medium or large private sector organisation. If either of these apply, the private sector engager or end client will be responsible for determining whether the off-payroll worker would be an employee of the end client if they were to supply their services directly rather than via an intermediary. Where these rules apply, the private sector engager or end client, or the fee payer if different, must deduct national insurance from payments made to the worker's intermediary. This is very different to how off-payroll decisions are made currently. For 2021, the PSC can still decide if the off-payroll rules apply in the private sector, commonly known as inside IR35. The impact of the changes on workers supplying their services through a PSC will depend on the nature of both the end client and the arrangement in which the services are to be provided. In cases where services are supplied to an end client, which is a medium or large private sector organisation, through PSCs or other intermediary, from the 6th of April 2021, the PSC will no longer need to ascertain whether they are inside or outside of IR35 rules. The onus will instead be on the end client, who will need to determine whether the off-payroll rules apply by deciding whether the arrangement between the parties would be the same if the worker supplied their services to the end client directly rather than through a PSC, and decide if the employee would normally be an employee of the end client. Following a decision from the end client, the worker will be given a copy of the determination reached as to their status for the role or project. The worker should check they agree with the determination and ensure they are raising it with the end client if they don't agree. Where the off-payroll working rules apply, payments made to the PSC will be made with tax and national insurance already deducted. This does not mean that tax and national insurance is paid twice. The worker will receive a credit. If you are lucky enough to secure a role or project that is not subject to the off-payroll working rules, the PSC will be paid gross. Tax and national insurance will be due on payments made by the PSC to the worker. The extended off-payroll working rules do not apply to small private sector organisations. Where a worker supplies their service via a PSC to a small private sector organisation, they must continue, as they do now, to assess whether IR35 rules apply. Where they do, the PSC must calculate a deemed payment on the 5th of April at the end of the tax year and account for the tax and national insurance on that deemed payment. The extended off-payroll working rules do not change how the end client makes the payment to the worker. They would continue to make the gross payment to the worker's intermediary. Off-payroll working rules have been applied for some time now, since 6th of April 2017, where services are supplied to a public sector body through an intermediary. The extension of the rules from April 2021 do not change for the public sector. The public sector body will continue to be held responsible in deciding whether the rules apply and deducting tax and national insurance from payments to the worker's intermediary where required. The PSC does not decide whether the IR35 rules apply. I hope that's useful. If you'd like to know any more, please get in touch with us. If you'd like to see more videos where we answer lots of questions on tax and accounts, take a look at our YouTube channel. You can also subscribe for more videos.